Let's take a deeper look into the banks. Wells Fargo is on the move after hours after news that Berkshire Hathaway cut its stake in the company to 3.3% from 6% previously. Let's bring in Jeff Harte, Piper Sandler analyst. Jeff, great to have you with us.
Good afternoon. Good to be here.
Was that a good move on the part of Berkshire, the notion of cutting one stake in Wells Fargo here in half, practically?
Look, banks have performed better recently, and that's been kind of nice to see, but you got to view it through the lens of they've been pretty lousy performers for a while. So it's a little bit of catching up. I think Wells Fargo, Charlie Scharf will get things right. They'll do the right things there, but it's just going to take a while for it to play out. So, I mean, as I look at banks, I kind of find myself looking at liking the universal banks, the Citigroups, the JP Morgans, the Bank of Americas, even the Goldman Sachs. You know, we're at a time in banking right now where scale matters more than ever before, and these guys have it in spades. So I think when you're looking at banks, you're looking for guys with scale like those guys have, and you're looking for revenues that are not as dependent on kind of your traditional spread lending, because the interest rate environment's tough. And though it's gotten a little better, it's probably going to be a long time before it gets a lot better. And there's not a lot of loan growth out there. So the more you can get some capital markets revenues and asset management revenues and custody fees and kind of, non-interest spread related revenues, I think that's the place you want to be looking at banks.
We've been debating banks here on the panel, Jeff, and basically it seems to come down to how you view the economy in the future, whether or not you view unemployment getting worse, whether or not people are going to be, foreclosed on, et cetera. Do the banks have enough in terms of reserves right now, and under what scenario do you think those reserves are enough?
I do think reserves have been built enough. Not that we couldn't see some more in the next quarter or two, but I think once we get into next year, it's going to be a matter of releasing the reserves. I mean, we've kind of seen them take their reserves up to a level that would suggest losses get, close to half as bad as kind of they were in the Fed's super, severely stressed scenario. And that seems reasonable to me because, I mean, the amount of stimulus we have out there is really helping a lot. A lot of the kind of regulatory forbearance is helping a lot. And we're in the unique position where the jobs numbers were really bad, don't get me wrong, but they're getting better fast. I mean, people can go back to jobs. The economy, the fundamental under economy was pretty good. So, I mean, I think if the economy keeps improving, which I think it will, that's generally good news for the banks because they're kind of the lubricant that kind of keeps the economy going on the financing side. But when I look at banks in general, it's still hard to overlook a tough rate and tough loan growth environment. So I still find myself, looking at somebody like a JP Morgan. I mean, what I like about a JP Morgan is if we go into a double dip recession, the things really get bad. The strong get stronger. JP Morgan is strong. They're going to come out of that a winner. If the economy gets better and things get a lot rosier, they've got leverage to capital markets and things like that. So I think they're kind of well positioned to do well in almost any environment we come into.
Jeff, the argument I've made for a while is, banks, to me, it's not about PE ratios. To me, it's about price to tangible book. And I think I've made the argument that I think JP Morgan deserves that premium valuation. But right now, as the market closes, we're looking at a Citi, which tangible book last quarter was reported around $72. The stock is trading at $52. I think it should trade at a discount, but should it trade at that steep a discount to a name like JPM?
No, I don't think it should. I mean, kind of the overall thinking, right, is if you can earn something close to your cost of capital, you should trade it close to 1 times tangible. Citi may not be hitting it, but they're a lot closer than that valuation discount would suggest. So I do like Citi here. But I think that the kind of difference, I was talking about JP Morgan, I think you buy it today, you kind of win either way. Citi's probably a better way to play the bullish sentiment if you think the economy is going to be better. Because one of the reasons they're kind of lagging the peers is they've got a much bigger credit card portfolio. You tend to see bigger losses here, and you tend to see them sooner. If those losses don't actually materialize because the economy kind of comes along better than we expect, I mean, this Citi's set up to be a winner there, but you got to have that kind of macro view and be willing to be patient here a little bit relative to owning something like a JP Morgan.
Jeff, great to see you. Thank you. Jeff Harte, Piper Sandler. Jeff had mentioned credit card exposure. I think that's interesting. Just about a couple weeks back or so, Capital One Financial CEO had made comments that they don't really have a good grasp on whether or not their borrowers are employed or unemployed, that there are a lot of borrowers out there at varying degrees of unemployment. And so a lot of these cards are tightening their lending standards. Brian Kelly, I bet this caught your eye.
Yes, this is exactly the issue that you have with the banks, with credit card companies, is that you don't have a good idea of, number one, what your lender looks like at this point, the one that you're lending to, and then number two, what the economy is going to do. Are they going to go back to work? Are we going to remain at an elevated level of unemployment? And if that's the case, something like a Capital One, which tends to be a little bit lower on the credit scale, is going to have a whole lot of problems. So until I see some kind of sign that we haven't kind of plateaued here, I think you got to stay away from these.